Everyone, welcome to inventory part 9. We're going to be talking about inventory valuation, or how we use the lower of cost or market. So what is the lower of cost or market? Well, we have inventory. As accountants, we're conservative, right? So therefore, we do not want to overstate the value of our inventory. Thus, we need to evaluate or value our inventory to ensure that our inventory is being shown at the lower of cost or market. There's a couple of ways we can apply the lower of cost or market approach. One of the ways we can do is we can look at the overall inventory, right? If we just have oil, we can just say, well, we've got this many gallons and this is what it's cost, and this is now the market value. And depending on what those are, we'll make the appropriate adjustment. We have groups of inventory items. So if I have, say, if I'm running, I don't know, say like a motorcycle shop, I've got motor scooters, I've got motorcycles, and I have bicycles. I can apply lower of cost or market by groups of inventory items. The way that we're going to be looking at, though, we're going to be going through and looking at individual items. We're going to be looking at each individual item. We're going to say, do we need to go through and make an adjustment? Very, very important, though, is like once we take it down to market, we do not subsequently write it back up. There's some exceptions to that with different types of assets, but with inventory, we have to make sure that we go through and record it at the lower of cost or market. Now, the other thing is, for this point, I'm going to be giving you what the market value is. When you take intermediate accounting, market is defined differently. It's defined as the middle value of net realizable value minus the normal profit margin, and then replacement cost. But for our purposes, I will be giving you the market value. Now, there's a few different approaches. Once we come up with the adjustment, as long as the adjustment is immaterial, meaning it is not significant to our cost of goods sold, we can just go ahead and debit cost of goods sold and credit inventory, right? That's as long as it is immaterial. What is materiality? It's going to really depend. It's quantitative, qualitative. Some people say it's around 5%, but for my questions that I'll be giving you, I will help you define. Basically, they're going to be immaterial. Now, if the amount was materially significant, meaning say that if my amount of my adjustment for lower of cost of market was say 100,000, my total cost of goods sold was 200,000. If I'm making the adjustment to cost of goods sold, 100,000 divided by 200,000, that's about 50%. Then I would need to do this. I would need to debit a loss on inventory obsolescence, and then I'm crediting allowance to reduce the inventory to the lower of cost or market. This is why we have to be really careful with inventory. I gave an example earlier. If I bought a bunch of iPhone 3s for $700 each, and I still have them today, I'm in big trouble, right? Because those iPhone 3s are no longer worth that $700 per iPhone. They might be worth about $20 if I'm lucky. So you got to be really careful when it comes to inventory. We have to show inventory at the lower of cost or market. So I want to thank you. Please leave any kind of questions you might have below. Appreciate you liking and subscribing to these videos, and I look forward to seeing you on the next video. Have a great day.